Right, good. So I think that's everybody with us. Good. So finance mastery. The first thing I'd like you to do is, because everybody's got a slightly different understanding of finances, different sort of level of competence within this. So the first thing I'd like you to do is just type into the chat box, okay, what's the key thing you'd like to get out of today? Okay, so around finance, around all the things that you might be working on in your role, or you know, in the different areas of your business, just type in what's, out of the 2 hours we're going to spend together, what would be one really good takeaway that would be of benefit to you going forward. I'll just take a couple of minutes to just type something in the chat box, and I will keep a view of it over here.
Why isn't that working?
Are you there, Anna? Good. So Ranji is financial KPIs for my architecture. So key performance indicators. Yeah. So what? How do we identify the right ones? So Sabrina, again, that's good. How do I identify KPIs? What else? There must be a few more things that you want to get out of a finance workshop. So direct operations, and like to better understand your management accounts and financial reports. Great, excellent, good. We will cover that one as well. Yasmin, is Yasmin your name? So if I say Yasmin, is that you, or is that your so somebody else's computer you're using? Could you just type in your name on there, just so I make sure I do call you the right name? All right, Phil's just joining us. Good. Josh, Rachel, come on. You've got to have something there. One of you's going to have to So Fatima wants to be able to understand a set of accounts that are provided by our accountants. Good. Yep, that is important to re-understand what goes into those. Great. It is Yasmin. Excellent. Thank you. Josh is delegating to Rachel to type. Good. And Phil, Phil's just joined us. So Phil, we're just typing into chat box, what's one key thing you'd like to get out of the session today? So out of the finance workshop. It'll be late, yeah. Well, Stephen's meant to be coming, he's late, so give it 15 minutes and then I'll have to pick it up when they bell. You got any others coming through? Are we struggling typing? Sabrina, have you commented? Any others? Oh, and my understanding, the secret world of finance. It's as you'll see, it's not so much a secret as something that finance people like to make overly complicated, so other people think that they're extremely intelligent.
I think there is some phrases, but there's some ladies on the line, so I won't necessarily use them.
Yes, yeah. There's lots of phrases and different things that people use. So once you understand the lingo, then it's a much easier place to be. So cool. Right. I think everyone that's going to contribute has put. Oh, one more. So Anna, I'm here. So again, that's the operational thing and understand the finances. Excellent. So what I'm getting from this, two key things: which KPIs, how do I find the KPIs for my business, and how to really understand the financials within the business. So if I'm looking at profit and loss, balance sheet, how do I understand those? Cool. So we're definitely going to cover those. And what I want to do to sort of really kick off is, in all of my workshops, I start with this formula. Okay, this formula: B times do equals have. So if you haven't seen this before, please write this down. It is the formula for life success. So whatever you want to be successful in life, this formula must stack up. So if you want to have success around finances, the same thing's true. This formula must stack up. So you've got to have clarity around what you want to have. Okay, so if it's around money, it's around finances, you've got to be clear how much and what it is. But also, if in understanding, you've got to be able to understand, well, what understanding do you actually need? Then you've got to work on your knowledge, attitude, and skills. And then you've got to put that into action, actually have a plan, and actually, to try it out, to give it a go, and learn through actually using this. Okay, if we just do it and then ignore it, then you're not going to move forwards. So if we look at the B first, let's just start with a few beliefs. What I want you to just have a think about is, what are your beliefs around money? Okay, so what are your beliefs around financials and money and numbers within a business? So what I'd like to think about is some negative words that you would use to actually describe money. So something you believe to be true. Okay, so something you hold to be true around money. Again, if you want to pop those in the chat box, that would be great. So when I say money, what's the first thing that comes into your head? So good, bad, but think about some negative beliefs you have around money. What have we got? Just type them in the chat box. Shouldn't be more than a few lines. So have we got anything down there? Or in the small chat box? No. I was wondering where Josh and Rachel had gone. Their camera's obviously frozen. Good. So we haven't got any, no negative beliefs. Come on, Rand, you take your mic off mute. Let's do it the old-fashioned way, and you can just chip up. So what are some negative beliefs you've got around finances and money?
That money is evil.
Money is evil. Okay, cool. That's a good starting point. A lot of people sort of will state that one. Anna, what about you? What are some statements for you?
I guess not having an accurate knowledge of what the real current position with money is.
Okay. Yep. So I don't know where I am at the moment, and therefore
it's a fear of the unknown, I guess. Yeah.
Yeah. So sometimes if we don't know, then we're a bit fearful of actually finding. You know, is it good? Is it bad? Oh, I'd rather just put my head in the sand and ignore it. Yep.
Yep.
Good. Phil, what about you? You came up with one sort of to start with about the sort of what was your words there? The secret world of finance. That finance is a bit secret. Any other sort of thoughts around it?
I think similar to the other two, really. It's just looking at what money can either breed one way, it can either breed happiness, or it can be, as a word, evil. You know what I mean? It's just having the knowledge of where you are at financially, because that then makes your business decisions clearer if you've got money. And then also there's the other element of it that you try to be too greedy to make money, and therefore you don't make as much as you need to make.
Yep. So money drives greed. There's another negative one. You know, sort of rich people are sort of bad people. You know, it turns good people into bad people. You know, so there's a lot of beliefs around money. So the first thing you've got to question is where is your belief set right now? You know, do you see money as something that is good and helpful, or is it something that's negative and bad and holds you back? Okay, because the relationship with money can be a big indicator of whether you will be successful in business, and move forward, or it will actually sort of be that millstone around your neck. Because the first thing you've got to understand is really, when we talk about money, on one hand, you know, or the question to ask is numbers, so the finances and the business, is that a left brain activity, so a logical, analytical, or is it a right brain emotional? Okay, so the numbers, when we talk about profit and loss and balance sheets and cash flows, and borrowing money and things like that, which part of the brain for you fires? Is it the emotional one that you get emotional about it, or is it a logical one? Okay, so just have a think about in your own mind. Do I think finances and numbers as logical process, or do I get sort of emotional about it? So some of those words that we were using were very much on the emotional side. Okay, because what happens is, as soon as we start thinking about something, that thought drives a feeling, which drives an action. So if I think negatively about money, I'll get a negative feeling. I'll feel uncomfortable. I feel sort of worried about it. I feel stressed about it. And when I feel stressed about something and worried about it, the behavior that I then show will actually back that up. So our brains are wired to move away from pain. So if I've thought about something that's made me feel bad, then my actions, my behaviors will run away from it. And that's what I find a lot in unsuccessful businesses. It's not that the business is not successful, couldn't be successful, is because the people in it are running away from the numbers. Because they don't understand them, they're scared of them, they think it's a secret, they're worried. That causes a negative feeling, and therefore their behavior is, I'd rather not know. Because if I know, it's going to drive more bad feelings. Okay? So the first thing we've really got to understand is we've got to move away from this factor of this connection of emotion to the numbers. Okay, the numbers are just numbers. They're not good, they're not bad. Okay, they are just a set of performance metrics based on performance that's happened in the past. So they're a true reflection of what's happened in the past, but they are not a true reflection of what could happen in the future. We can predict from them, we can make decisions, we can look at them, and guess. But just because you have bad numbers last month does not mean you're going to have bad numbers next month. Only if you do nothing about a change of activity that will drive it forwards. So when we look at these negative beliefs, the first thing you've got to do is you've got to admit to yourself that you have them. Okay, because there is not a successful business person out there that I've ever come across that has negative beliefs around money. On the contrary, the more successful people tend to have this more positive view of actually achieving more money. They want to attract it. They want to pull that money towards them because it makes them feel, for whatever reason, it makes them feel good. It makes them want more of Okay, so we've really got to understand, if we've got some negative beliefs, the first thing we need to work on is those negative beliefs, because otherwise, no matter what happens, you'll start moving away from it. Your behaviors will be anti-money rather than positive for money and positive for financial results. So it's a little bit like a sports person being scared of the score. Now, there's no sport out there that the sports player is scared of the score. They love the score. They want the score to be positive. If it's a negative score, that just drives them on to do better. And that's what we want to do within our business, is just because it's a negative number doesn't really matter. We want to use it to actually turn it into a positive number. So we should celebrate when we have a negative number, and we should celebrate when we have a positive number, because it's just past data that then influences our actions to actually move forwards. So if you have these negative beliefs, they will drive this fear, okay? So this false expectation appearing real. So if I take an example, Sabrina, are you unmuted there?
I'm unmuted, yes.
Good. So let's take an example of last month's profit and loss account showed £100,000 loss. Okay, let's assume, from your accounts, they showed £100,000 loss.
Yes, as long as you're just assuming that, that's all right, yes.
We're just assuming that. So give me a potential fear that could come as a result of seeing a loss from last year.
Well, an overall fear would be that you might be on the slippery slope to not surviving.
Yep. So last month I've not done well, so therefore this month and the next month after, the month after. So we start to project forwards all the negatives that could happen as a result of that, don't we? Yeah. So we lost money that month. Next month, suddenly, all the money runs out, no cash, business goes bust. Okay. So now assume that we made £100,000 profit last month. Now what are your expectations going forward?
That actually you're doing all right, and if you can keep doing that, you might even be able to invest in the business.
Great. So now we're seeing that everything's rosy going forwards, and we can be making more money, and that was a great month. If you can think about it, the reality is what happened last month has got nothing to do with what's going to happen this month. I could have made £100,000 profit last month and lose £100,000 this month. I could lose £100,000 last month and make £100,000 this month. Yet that false expectation appearing real potentially will actually make it happen. Okay, so we've become very blinkered, we've become very negative in our thoughts. Or if we've had a good month last month, we go, yeah, last month was brilliant, made £100,000. And we do nothing to actually improve the position this month. And therefore this month, we're more likely to lose money than we would do if we'd lost money last year. We've actually got off our backside and done something about it. The only thing we can control is what we do now and what we plan to do in the future. So first, we've got to really understand that emotion that we get from whatever the number says, we've got to get rid of that emotion. Because that emotion, if it's too positive, will mean we become lazy and we do nothing. And if it's too negative, is we fear and we freeze and we do nothing. Okay, so whatever the number says, it's almost irrelevant. We should be thinking about, right, forget that. That's just happened. Let's look at the plan going forward. Okay, we need to understand it, but not get emotional about it. So for me, numbers are all, if we can keep that left brain kicked in, then we're going to cope with this far better than we would do if we were, going, when it's great, we feel really great. When it's down, we feel really down. It's irrelevant. It's history. It's done. All we've got to do is focus on what's coming next. So once we understand that, then we should get into this whole idea of let's measure everything. The more we can measure, if I don't get emotional about it, I then have no fear about measurement. Therefore, I should be measuring everything, because what gets measured gets improved. If you look at your top level sports teams now, look at the British cycling team, they measure absolutely everything: heart rates, oxygen intake, rotation, airspeed, all these things, because they're looking for those tiny, tiny marginal gains. Okay, whatever that number is, all we're trying to do is say, how can we be a little bit better than that number next time? How can we improve it by 1%, 10%? Small incremental improvements. And if we just see the number as being a number, then we're able to do this. Okay, we can really look and focus on it. So if you think about any game you play, any game you play really has a scoring system. Okay, there's a way to score how well you're doing. Okay, so in chess, how do you score how well you're doing in chess?
The number of pieces you've took.
Number of pieces I've taken. Okay, now, does the number of pieces you've taken always, if you've taken more pieces than the opponent, does it always guarantee that you're going to win?
No.
No. Okay, but it's generally a good indicator that you are doing quite well. Okay, so these are all just indicators of how well we're doing. It's not always directly attributable to the end result, and that's what we've got to see. We measure it, we improve it, okay, because that will make it better. But we've got to identify how it relates to the end result. It's not always. You have great KPIs, yeah. So I could have a really good score here on my, playing golf, and I could shoot, 3 under par, and have a fantastic round, and I could still lose because somebody else could play and score better than I scored. Okay, so we've got to also understand our relationship with those numbers between the actual game that we're playing. Okay, so KPIs, measure everything, but understand how it relates to the end game. So they are just a mirror on the past. Just because they say what they say does not reflect on what's coming forwards. So we've got to look at this and say, look, they are just a score sheet of what's happened. They can be a barometer. There can be trends. So if we've always scored at this level, then there is a reasonable chance we'll score at the same level next time, but it's not guaranteed. As long as we do things to change it, we can actually move it forwards for the better. They should always motivate us. Okay, so if we've got a bad score, we should be motivated to get a better score. If we've got a good score, we should be motivated to do another good score. Whenever you see numbers as demotivating, then in my book, you're looking at them wrong. Yes, you can get upset. Yes, you can get fed up with it. Okay, but you should always look at any numbers you get as being a motivator to move you forward. That's a real key. If you start looking at numbers and get demotivated, then that emotions come in, in a negative way, and that's the belief you've got to overcome and change. Generally speaking, they are universally understood. There is no different language. There's no French numbers. There's no German numbers. There's no sort of, I think numbers are Arabic anyway. Okay, so they are globally understood as what they are. They're very hard to misinterpret. £100,000 loss is equivalent to €100,000 loss, to $100,000 loss, £1,000 loss. People all understand numbers. So if you can get the culture and the universal language in the business about numbers, then you lose this sort of ability to say, I think we did really well last month, but that's in my terms, my world. You might not think it the same. So there's no misunderstanding when we actually come down to real numbers. We can use them as a comparison, so compare one period to another period, to budgets, and they are just a reflection of what's happened in the past. That's the key to remember. They are only a reflection of what you've done in the past. They are not a true reflection of what's going to happen. Because you could change your decisions, you could change everything going forward and have a completely different set of numbers. And they should allow us to make better and quicker decisions. That's why numbers have got to be real time. So if we go back to my golf analogy, there's no point in me knowing 3 months after I've played a round of golf what my score is. I've got to know immediately as I actually do it what my score is. Therefore, I can then change the way I play the game to improve from what I'm actually doing. So speed of numbers is so critically important. We've got to get used to getting these numbers through as quickly as we possibly can. Instant feedback is ideal. So, and at the end of the day, you know, when we look at a business, the numbers ultimately come down to sales, costs, and profit. And without profit, you can't have cash flow. And without cash flow, you have no business. So the numbers are the lifeblood. It's the blood that runs through. It comes in, it goes out, it keeps the business alive. So if we have any fears around numbers and lack of understanding, then we can't make these decisions. We can't actually drive our business forward. So we've got to learn to love numbers. Even if we don't fully understand them, doesn't matter, we can just ask the right questions. So as we grow our businesses, we've got to understand that there are different roles that we have to play. So some of you guys, you know, are employees in a bigger business. Some people are actually the head of the business. Some people are the whole business. Okay, does not matter. Doesn't matter where you are, but you've got to understand your position and what role you play when you look at the whole numbers. So we're going to draw a little organisation chart. So at the top of an organisation is the shareholders. Okay, and if we look at this and say, right, just a second. So top of our organisation chart is our shareholders. Who reports directly to the shareholders?
The MD.
Directors.
Yeah, so the MD is responsible directly to the shareholders. Then there's a marketing director. Okay, so the marketing director is responsible for, well, I'll put the roles up in a minute. So we've got a marketing director, we've got a sales director, we've got an operations director, a finance director, and an HR director. Okay, so these are the key roles within any organisation. So when we break the numbers down, yeah, every director at this level owns that part of the profit and loss account, that part of the game. Okay, so a shareholder is looking at shareholders' return. Managing director is about driving profit. Marketing director is about generating leads. Sales director is about converting those leads. Operations director is about direct costs and delivering on time and on budget. Finance director is about the financial security, and the HR is about happy people. So each one of those. So if you are just a one-man band, or you've only got a couple of people, you still wear all of these hats. You wear a shareholder's hat, you wear a managing director's hat, you wear a marketing director's hat, you wear a sales director's hat, and operations. So that's why when you run a small business, you are generally extremely tired all the time. Because you're doing so many different roles, trying to look at these numbers from different perspectives. And that's what's complicated in a small business. As the business grows, this becomes easier because, you know, one person looks after one set of numbers. So Phil, if you're there,
Yeah.
So your role in KFS is what?
Sales.
Sales. So which boxes do you look after?
So I should look after the sales box, but I end up doing a bit of everything. So, but sales box is the box I should be looking at. Sales and marketing, to be fair.
Sales and marketing, yeah.
The marketing needs to feed me and give me the leads.
That's it, yeah. So you have, sales and marketing, you look after those two. You've got another director that looks after the operations, and another manager looks after the finance, and another one looks after the HR.
Yes.
Okay, so you could be quite narrow and specialist in your set of numbers.
Yeah, focused on that element, yes. I'll need to know what our forecast is, what we need to return. And yeah, as long as those three give me the relevant information, hopefully I can then get my team to do what we need to do.
Yeah. So this if you looked at this and said, if this was like a game of football, yeah, then what we've got here is the ultimate goal of playing football is to win. Yeah. How do we win? We score more goals than the opponents. You know, we could look at this and say, well, these are our forwards, So these guys are about scoring goals. These guys are at midfield, and these guys are defence.
Mm.
So everybody will understand their position in the game, play their game the best they can to win, and actually know their numbers. And they each have a different set of numbers they'll be working towards. So let's start at the top. So our shareholders, what is the number one goal for a shareholder? What do they want? Why does a shareholder invest?
Return on the investment.
Return on investment, okay? So they're looking for a return on their investment. I buy shares in my business and I'm expecting a dividend and my share price to grow. So the game that we're all playing, yeah, no matter what we do, where we are, is the game for the business is to drive more dividends and more shareholder value and growth. Plus, look after the customers and make the world a better place. But the game that we're playing, the scoring mechanism, is generally around that. And in order to do that, we have to generate profit. Okay, that's the only way we do it. The only way in business is we have to generate profit, because profit drives dividends, profit drives actual growth in value. And if we don't understand that, in whatever role we are, then we can't play the game properly. So the bigger the profit, the better the company's doing. It's like chess. You know, the more pieces we take, the better we're playing the game. The more goals we score, the more chance we've got of winning our game. So for us in business, we've got to understand it's about the company's ability to make profit. What we do with the profit is a different matter. You know, there's many things that come, even charities, even when I coach charities, said, look, as a charity, your number one goal is to make profit so you can do good things with it. If you don't make profit, you can't do any good things. So the game is always about making profit. So that's at the top. So if our game is to make profit, yeah, then we've got to understand that's what we're all aiming towards. So the whole organisation is there to help the business to make profit. And by making profit, we can actually increase the value of the business. Okay, so as a shareholder, we're thinking if we do own our business, we should be thinking this. But even if we don't own our business, we've got to understand that the shareholders that do own the business will be thinking this way. So the way that we value our business is a net present value of future cash flows. So a business's ability to generate profit going forwards, because the past is the past, it's done. Just because I made £100,000 last year does not necessarily mean I'm going to make it next year. Okay, but the more chance I've got of making it next year, the more valuable my business is. So net present value means it's discounted back based on inflation and based on the risk that there is to actually generate that money. Or a multiple of earnings, of a concept called EBITDA, okay? Earnings before interest, tax, depreciation and amortization. I wouldn't worry too much about that unless you're into company valuations. The actual figure is just the net profit. It's just another term. So go back to Phil's point about the secrecy of accounts. These are just terms that accountants use, yeah, so they can charge very high accountancy fees. The end result is it's net profit. Okay, it's a slightly variation of actually the profit the company can make. So we're looking at a company's ability to make profit now and then multiply that by a number going forwards. So how many years profit is that business worth? So if I've got a business that's guaranteed to generate 100,000 profit for the next 10 years, yeah, potentially somebody would pay me £1 million for that business because they know over 10 years they're going to make £1 million. If that business has got very little chance of making £100,000 next year, I'm going to be lucky to get even £100,000. So these two things, the amount of profit it can make going forwards and this multiple, okay, is the key thing. On top of that, there is this net asset value, which is the amount of retained profit that the owners have left in the business to buy assets and stock and working capital. Okay, so I'm not going to go into too much detail with you on this one, but this is what shareholders are looking at, the value of their business. So its ability to generate profits going forward, how secure that profit is. Yeah, the more secure it is, the higher the multiple, the higher the valuation. The more risky it is, the lower the valuation. Okay, so we've got to look at that. So I haven't got. So EBITDA is earnings before interest, tax, depreciation, amortization. So it's the profit from running the business. So, but in effect, it's sales, cost of sales, gross profit, overheads, net profit. It's this figure here that is the key thing. So that's the commonality. We're all in business. We're just trying to generate net profit within our business. That's the key game. Okay. So this multiple that we look at when we're valuing businesses is really about the strengths of the business. So its systems, its processes, its ability to generate business in the future, the quality of its people, the quality of the computer systems it uses, the quality of the customer base that it has, the supplier base it has. The more robust it is, the more chance it's going to be achieving those profits going into the future. So if you took McDonald's, you know, if you thought about the multiple that McDonald's would trade on, it's going to be a very high figure, isn't it? Okay, because McDonald's is likely to be producing profit, you know, year on year on year for a long time to come. If you looked at the profits now of, you know, a company that's been hit quite badly, you know, probably Virgin, let's say Virgin Cruises. You know, Virgin Cruises multiple now is going to be quite low. Okay, it made loads of money in the past, but it's going to be quite low because no one knows where that market's going to go. And that's what the whole stock exchange is built on, is trading on that multiple. You buy on a low multiple, you sell on a high multiple. Okay, so we're looking at those things. So this is the average. So the average is of all company sales is around about just under 2.5. So part of the shareholders' goal is to increase that 2.5 up to 3, 4, 5 times. Okay, we do that through the systems and processes and people within that organisation. So we're looking at ways to actually achieve that. So as a shareholder, yeah, my conversations with my managing director is Mr. Mrs. Managing Director, yeah, A, how are you going to maximise my profit? And B, how are you going to maximise my multiple? What plans have you got in the next 12 months to make sure I've got more profit and increase my multiple? Okay, because if you do that, then I'm a happy shareholder. If you don't do that, then well, what are you doing? Why am I paying you to run my business? Now, for those of you that are the shareholder and the managing director, yeah, you need to have that conversation with yourself once a year. Okay, and that's what your annual general meeting is all about, is as a shareholder, are you happy that your managing director is actually running your business well enough? And if they're not, then perhaps you should sack yourself as your managing director. Because the shareholder, that's what I want.
You're like writing.
Can you get that? You can. Okay, if you're not performing and you don't have a plan to perform better, then why would I leave you running my company? Right? Now, as a managing director, you might turn around and say, "Well, look, I'm learning. I'm working with a coach to actually learn this stuff." Okay, but you could turn around and say, "Well, actually, how much are you paying me as a managing director? Not a lot." Well, you get what you pay for. Okay, so we've got to understand this conversation needs to happen. But then you've got to then do something about it. So the MD's job then, so the shareholder's job is just to employ a decent managing director. The managing director's job then is to come up with a plan to actually increase that profit and that multiple. And to do that, they need to then sit down. So this is a system we use, which is called Value Builder, which is basically a way to actually increase that multiple. So how do we get a higher level multiple? But I'm not going to go through that with you today. So that multiple can be increased through getting that strong foundation. Okay, so if we're controlling our finances, our time management, you know, we're actually running a good solid business, we increase that multiple. The niche, if you remember back to our 5 ways, that's all about increasing the net profits. That increases our EBITDA figure. So we increase a higher level of profit. We put systems in place, which increases the multiple. We increase the team, improve the team, which increases the multiple. We put the manager in place, which increases the multiple. And ultimately, we then go on acquisitions and we add other businesses, which then increases the multiple and increases the profitability. So when you come back to the foundations of the action coach process, it is there to drive increased profit and increase multiple for our shareholders. Because that's what we're trying to do. We're trying to play the game at a high level. So if we look at this and say, right, that's the ultimate game. So if we're not clear, so yeah, Phil, for you as a sales director, is what I've just said there, is that sort of news to you, or have you been explicitly told that, or have you gleaned that over your years of doing what you do? So did you hear that, Phil? Hello, have I lost Phil? I think I've lost Phil. So let's take Josh, are you there? Can you unmute yourself?
No. Hello.
Yeah, cool. So does that, how does that sort of come across when I sort of say that to you? Because you're fairly new into this role, you sort of within A. Roberts. So
I don't know. It's can you just repeat it, Kevin?
So what I've just talked about there, about from a shareholder's point of view, we're trying to increase the profits and increase that multiple. Okay, so from your position as an employee of the company, how do you perceive that? Is that a surprise to you, or does that make sense that, yeah, well, of course you would. If you're running a business, that's obviously what you want to do.
Yeah.
Have you never really thought about it?
No, I'm not sure. No.
And I think that's one of the key things. And that to me is the difference between manager level. So if I'm a manager and I'm taking responsibility for an area, and an employee, I wouldn't expect an employee to really understand that. An employee comes to work to do a job, to get paid, to go home, have a nice weekend. When we move up into that senior manager level, we're starting to take ownership of an area, responsibility, and we're going to have these measurements. If we don't understand what game we're playing is, then whatever measurements I give you, you're not going to understand how it fits in with the whole thing.
Yeah. Okay.
And that's why, to me, it's important for everybody in the team that's playing this game. We've got to understand what the game is.
Yeah.
Because that'd be like playing football and you're in defence and you've got no idea that the reason we're playing football is to score goals.
Yeah. You're going after your goals.
Your KPI will be tackles made, but don't care. Well, I make a tackle, but I'm not kicking the ball upfield so that my team members can score goals.
Yeah.
So we're never going to actually move forwards.
Yeah.
Okay. So we've got to come back to this mindset of anybody in our organisation that is at this level, and say it's not for everybody, but for the senior manager level, has got to understand the game we're playing is increase profits, increase multiple, drive shareholder value. Okay, because the more we can do that, the more money the business can make, the more it can reinvest, the more it can grow, the more opportunities there are for everybody in the business to grow. Yeah, and that's how businesses continue and go forward. Otherwise, they hit the plateau, they stagnate, and then eventually they just die. Okay, so we don't have our mindset on this. So let's look at these different roles then. So we go to the finance director's role first. Okay, for no real reason that, you know, that we've got to start somewhere, and the finance director is probably the only person aside the MD that really sees the whole picture. Okay, that has a finger in every single area of the business. So these are the key factors that we've got to understand if we're wearing the finance director's hat. So for those of you that, you know, are running small businesses and you are in all of these seats, you've got to understand these. For those like Phil, I've got to understand that there's got to be somebody else that will be looking after this stuff, but we should also understand how it works. So the first thing, so these are my sort of 6 key things. So bank reconciliation, cash flows, aged debtors and creditors, profit and loss account, balance sheets, annual budgets. So I'm going to go through these reasonably quickly. Okay, I'm not going to go into how they are, just that you've got to understand them if you have that responsibility for them. So I know some of you on this call, you know, are looking after the whole business, and you've got to understand all of this. So the first one is the bank reconciliation. Is all of our transactions that we do eventually go through a bank account, and we've got to make sure that our accounts, internal accounts, are always in alignment with the bank, with actually what's in the bank account. And that way money can't go missing. You know, if it's in or gone through the bank account, we can keep track of it. So we've got to reconcile each bank statement, so the last bank statement, to the amount actually in the accounts. And sometimes there are payments that we've made or receipts that we've made that haven't actually hit the bank yet. So we've got to adjust for those and then reconcile our balance to bank balance. If all the transactions have gone through, then they will be the same amount, same balance. Okay, but often they're different. So that's where we need to do that. Now, for most of us, or most of you, you've got computer systems that do this automatically now. Okay, but you should always, you know, if you are looking at the account system, you should always be looking at the bank reconciliation as your starting point. If your bank doesn't reconcile, there's no point doing any other accounts because things are missing. Okay, so that's number one. And always remember that the bank statement is a mirror image of your account. So a debit to you is a credit to the bank. A debit to the bank is a credit to you. So when you look at a bank statement, debits and credits will actually be the other way around. Okay, so just be aware of that one. But I'm not going to go too much into detail on that. So the next one is our cash flow. So we've also got to predict where our money is going to be, because if a business runs out of cash, yeah, it can be the best business ever, but it will struggle. Okay, because cash is the lifeblood of a business. It runs. If your body runs out of blood, then the body dies. So we've got to make sure the cash, which is the lifeblood, continues to come in and go out of the business. It flows through. If it stagnates in the business, you're not doing particularly well. And if you run out of it, you're not doing well either. So there's got to be that right flow, and our cash flow, yeah, actually allows us to see that. So the money coming in, our opening balance, the money coming out, closing bank balance, and we project that forwards. Now, if you're a cash business that money comes in and goes out on a weekly basis, it should be a weekly cash flow. If you're more of a business where it generally comes in monthly, then it can be a monthly cash flow. Okay, so you just choose your pace, which is right for you. But you should always, your business should always have a cash flow forecast in. Okay, even if you've got lots of money sitting in the account, you should still do this. It's still an important activity to make sure that happens. So every business should have one of these. Then we've got to look at ways to generate cash, you know, because the more cash that we can drive into the business, the better. So one of the quickest ways to increase cash in your business is to put your prices up. Okay, because you put your prices up, that generates profit straight away. So wherever possible, we should be looking at ways to actually increase our prices. Now, for some of us, it's not possible, but at least once a year, we should be looking to actually increase our prices. Because of inflation, costs are always going up, and if we don't, then we get left behind. And it's harder to, if you leave it a few years, it's harder to deal with than if you do it straight away. Okay, so we've got to make sure we do that. Then we've got to reduce where money gets tied up. Now, money gets tied up in debtors, so in effect, money we've lent to our customers to buy our products and services, and it gets tied up in stock. So it sits around in things that we're actually hanging on to. So the quicker we can turn this money into cash, so put our money in from our debtors or sell products and stock and turn that into cash, the more lifeblood comes into our business. So we've got to make sure we minimize our stock values and minimize our debtors. Okay. Another way it can get stuck is it gets stuck in assets. So fixed assets that we're not using anymore. So plant, equipment, things that are just cluttering up the place that if we just sold, turn that into cash, realize the cash, we can then reinvest that back into the business. Okay, so all of these items here, those top few are all on the balance sheet. Okay, so that's where I'll explain the balance sheet in a bit more detail a bit later. So we can also reduce our cost of sales. So our buying, how much we're buying from our suppliers. We can reduce our overheads, how much goes into running the business. So rent, rates, light, heat, all of those fixed costs that we can't do away with. Or we can actually borrow money in, so we can actually pay our suppliers slightly later, get extended credit terms, and we can borrow from the bank, overdrafts, etc. Okay, so we're always looking at ways to improve our cash flow. The more cash we have in the business, the more we can actually compete and the more we can do with it. Okay, so you should always have one eye on these things to actually bring cash into the business. So for our aged debtors and creditors, we've got to be looking at this on a regular basis. So I know, Sabrina, we've been doing a lot of work with you on debtors and creditors. It's amazing how if you leave this for too long, you end up with a hell of a lot of money just tied up and basically lent to people for no return on that money. If you went to the bank and said, could I borrow £100,000, they would be charging you interest. Yeah. But we lend money to our debtors and we don't charge that interest on it. Okay, so we've got to make sure that we're clear who owns it, who owes it, how long has it been outstanding, reduce bad debt, so always be contacting our clients to make sure they pay us. Check that every single invoice goes out on time, and is correct. There's nothing worse than not being paid and then being told 2-3 months later, oh, I didn't pay it because the wrong PO number was on it, or that you've done a miscalculation. And make sure the invoices are correct, out on time, so that the money can be paid as quickly as possible. We've got to get that cash into the business, that lifeblood back in. Control payments. This is where you have budgets, so you budget areas where you're spending lots of money, so we can get that money into the business. And if you gave one extra month credit, if you've got an overdraft, it will cost you £600 a month for every £100,000 you lend. Okay, so if you're borrowing money, which most of us are in some shape or form, if we lend 100,000, so we've got 100,000 debtors out due, it's costing us £600 a month to fund that. And what if you weren't doing that? What could you spend that £600 a month on? Sure, there's 101 things in your business that you could spend that money on. Okay, so it's a real key one, and often when businesses get busy, when they go through growth spurt, it's the one thing we take our eye off is the fact that a sale is not a sale until the money's in the bank, until we've actually cashed the money. So we've got to be looking at the debtors and creditors within our business. And this is a little example of our debtors, a debtor report. So we've got the customer down here, amounts that are due in 30 days, over 30 days, and over 90 days. Okay, so a total balance. But often, if we've got lots of debtors, that can be a bit complicated. So a little calculation we can do is what we call debtor days. So how many days generally does it take our customers to pay us? Now, if I give 30 days credit, so they can give 30 days, I would expect my debtors day to be 30. Okay, because I've given 30 days credit, so I'd expect my debtor days to be 30. I can guarantee if you're giving 30 days credit, the best credit terms you'll get, or debtor days you'll get, is around about 45, probably closer to 60. Okay, so therefore you're actually giving more credit than you actually need to, because you've got to be on top of this and make sure everybody pays on time. And it is tough, sometimes that you've got to be careful of that relationship with your customers. Yeah, and that's why I always say get somebody else, not you as the owner of the business. Yeah, somebody else to actually collect that money in for you, so that you can maintain your personal relationship. They can just turn around and say, look, it's just a job I do. I just collect the money. Okay, and if you do get stuck, then use a debt collector. We've got a very good one that we work a lot with, a company called Debtor. Paul's a client. So get them chasing your money for you, because it's something you don't like doing. It's personal, but don't make that an excuse not to do it. You've got to be all over it. So those really are, those first three is all about cash flow, because cash is key. You've got to get cash into the business. Without it, we have no business. Now we move more into the sort of what I would call the traditional reporting. So our profit and loss account is basically a summary of our trading activity over a period. Now, for most of us, that's a month period. For some of you, that's a quarter. When you look at the annual account, that will be for a whole year. So it's just the ins and outs of our trading activity. So it starts with our sales. Okay, so how much sales have we done in a period? Our cost of sales, so how much did it cost us to produce that? That gives us our gross margin. So some people like gross profit, gross margin, it's the same thing, it's just different languaging. Less our overheads, which are our fixed costs of running the business, leads to our net profit. Okay, and that's really, when you look at any profit and loss account that you'll see, all you're seeing is a detailed version of those 5 headings: sales, cost of sales, gross profit, overheads, margins. Now, I've seen P&Ls that have been 4 pages long, but in essence, it's just those 5 numbers, just in a lot more detail. Okay, so never be scared of a profit and loss account. Okay, you're always thinking, where's the sales figure? Where's the gross profit figure? Where's the overhead figure? Where's the net profit figure? Okay, and we know the game of the business is to get more net profit. That's what business valuations are based on. So this is the ultimate figure we're trying to drive. Sales often is the sexy figure. I can, £10 million in sales is a nice big number, but unless it's driving profit as well, it's meaningless. Okay, so we've always got to be thinking, how is this generating us more profit? So if I want to make more profit, I've got to increase my sales, I've got to decrease my costs, I've got to increase my margin, I've got to decrease my overheads. Okay, this is the only way we can drive, profit to there. And if you do the sales and marketing workshops, you'll see that we break sales down into 4 areas: lead generation, conversion rates, number of transactions, average transaction value. So we're actually breaking this down at a high level. But the essence is exactly the same: drive sales, reduce costs, increase profit. And if you can see that on your screen, this is a sort of an example of a month-by-month budget. So, or it could be actuals, where we see it. We've got our sales at the top level, our direct costs, so the costs that go into the actual product itself, any direct labour, so again, labour that's directly attributable to the sale. That gives us our gross profit. We can put in percentages here, gross profit percentages. Then we have our overheads broken down, this time into 4 key areas. So salaries, establishment costs, sales and marketing costs, finance costs, gives our total overhead, and then our net profit. Okay, now I can break that down to another level of detail. So here, I'm now breaking the gross margin figure down into more detail about the sales. So now I'm going down to units, yeah, of an average transaction per unit, and the total of sales, which comes back to that sales figure. And then I'm breaking the cost down into raw materials, packaging, postage, and then I'm breaking the labour down almost, it could be down to per person. Okay, but the essence is that is still just this. Okay, it's just those 5 numbers, but now we're breaking them down to more and more detail. Okay, so it's a little bit like you're looking at a pin, yeah, and then you put it under a microscope and you go down to another level of detail, and you go down to another level of detail, you go down to another level of detail. And you're just peeling away the onion, getting down into the detail at each level. Okay, and we're doing that because we're trying to make better decisions, yeah, on what we do, what we improve. Break it down, improve each of the parts, put it back together again. So for those that are into motor racing, you know, it's the way you build an engine. You build it, you pull it apart, you file it down, you blueprint it, you make it run really smooth, and you put it back together again, and then you get a high level performance. That's all we're doing here with our profit and loss account. Okay, and then our overheads. So we had the 5 areas there, salary, establishment costs, or 4 areas, and now we're breaking those down into more detail. Okay, so we're just, you know, so if you imagine all of that with all of that with that, it's quite a big document, but all it is just that in more detail. Okay, so any questions around the profit and loss account? Has anybody got something that they've seen on a profit and loss account they didn't understand, or they want a bit more information about?
Kevin?
Yeah.
Can you just explain on that graph the difference between the blue, the green and the grey columns?
On the graph?
Yes. Because maybe I can't see everything, but what's the significance of the columns?
It's a picture of a graph.
Yes. Am I supposed to understand what the green, the blue and the grey columns are?
Sales, cost of sales, profit.
I can't see that. I can't see what you're showing me.
Oh, so sales is the blue column.
Right.
The light blue.
Yes.
Yeah. Cost of sales is the dark blue, and overheads is the green.
Green.
But to be honest, I basically typed in graph in clip art, and it's just a clip art graph.
Oh, I see. All right. So it's not significant. That's fine. Yeah.
It's just a different way of showing these numbers.
Yes. Okay.
You could show it this way, or you can just show it this way.
Yes. Well, I recognise the spreadsheets because that's what we're using now.
Exactly. Yeah. Yeah. So if you want templates of this, then email me and I've got templates of this. I know most of you are using this anyway. Okay. Now, if you've got a small business, you don't need to go down into necessarily this level of detail. But as the business grows, then you're going to need to know more of this detail. Okay. But what we're doing here is, you know, each one of these lines. So if I take packaging here, and this line here of 109,000, we'd be saying, right, how can I improve that by 10%? How can I save £10,000 on my packaging next year? And then I'd monitor my actuals to that. Okay, so this is how we start to, and I'll come to it in a second, how we start to build budgets. So any other questions anyone's got about the profit and loss account? Phil, is this sort of, you know, information you understand? I'm not sure if I've lost Phil actually. So, Fatima, Yasmin, what about you guys?
I have seen a P&L before. Sorry, this is Fatima. I have seen a P&L before. The the more detailed one I have not seen. I don't think I will see it anytime soon. But it's a lot of numbers. I guess it's just getting used to it.
Yeah.
Yeah.
Yeah, I mean, the key is don't be scared of it. You know, yes, it's a lot of numbers, but all it's doing is telling you this. It's that. What's my sales? What are my costs of sales? What are my overheads? What's my profit?
Yeah.
And if you boil it away, the only ones you really need to what are these two here.
Mm-hmm.
You know, what are my sales? What's my net profit? And to be honest, all you really need to know is what this one is.
Yes.
How much profit did I make? How am I going to make more profit next week, next month, next year? Then once you ask that question, then you need to go into the detail and say, right, well, how is that made up? Oh, that's made up of those things. So if I want to reduce, you look at the big numbers, because the big numbers are the ones where you can influence the most. So if I could save 10% off all my salaries, yeah, I would save £96,000. Okay, if I save 10% of my finance and finance and admin, I'd save 13,000. Which one should I focus on the most? The bigger number. There's more chance of me actually making that change and having a positive impact on my bottom line. But we should look at all of the numbers. All of the numbers we want to try and improve. Okay. So that's really, so when you look at a profit and loss account, that's all you're looking at is sales, cost of sales, gross profit, overheads, net profit. The trading activity, the money that comes in and goes out on a daily, day-to-day basis. And most of you will look at that because it's the most interesting of the documents, yeah, because you like to look at the profit and go, oh yeah, we made some profit this month. Okay. But you should never do a profit and loss account and produce a profit and loss account without the balance sheet. Okay, so the one that most of us have got to get to know and love is the balance sheet. Now, if the profit and loss is like a video of what's happened in your business over the last month, the balance sheet is a snapshot. Imagine all the money coming into the business and going out. It comes in, it goes out, it comes in, it goes out, it comes in, and goes out. And at the end of the month, you go, stop. Yeah, so like the old musical chairs. So stop, where's the money? Where's the money in my business? Because I guarantee at the moment, you have none of it in your back pocket. You don't actually physically, you could not go and touch any of the money that your business has made in the last 30 days. So you've got to then look at this and say, right, where's my money gone? So you take a picture, you take a snapshot, generally at the end of the month, because that's when we tend to do it, of where my money is. And to do that, we have a thing in accountancy world, yeah, called debits and credits. Okay, so if you look at profit and loss, there's always a debit, DR, and a credit, CR. Okay, and there's a big long history of how this came out to double entry bookkeeping back in I think the 1200, the 12th century, I think it was. So, but it's just a way of accounting for ins and outs. So credits are also debits. So where's my money gone? So my money's come into my account and it's gone somewhere. So it generally goes into assets. So I could buy some land with it. I could buy some buildings, some motor vehicles, some investments, etc. So that's where my money's gone. I've put it into things I can touch and feel, desks, computers. Okay, and they're fixed assets because they're fixed for a period of time, generally more than 1 year. So if I buy a TV, yeah, I'm going to get the benefit of that TV for more than 1 year. If I was only going to get it for the benefit for 1 year, I would probably write it off into my profit and loss account. It's just an expense of that year. Yeah, but for an asset, for cars, for plant and equipment, they're generally going to last a number of years. Okay, so I call capitalize them, put them onto the balance sheet because I'll get benefit for them in the future. I can put them into current assets. So assets that I'm not actually going to spend now in this month, I'm going to use them in the future. So that would be my stock, my debtors. I can put the money into a bank account. Yeah, it can go into the petty cash tip. I can have prepayments, things I've paid for now that I'll get the benefit in the future, like rates. Okay, and I can lend money to other people. Or I can get where the money's come from. So now I can actually borrow money to actually put into my business. So I can borrow that for a bank overdraft. I can borrow money from my creditors. I can borrow money from my PAYE. Yeah, I can take out loans. So this is where the money's actually come from. And when we start a business, we can start it by buying some shares in the business. I can leave money in, so profit I've made last year that I haven't taken out in dividends, I leave it in as reserves. And I can make money in the period that we're looking at here. Okay, so a balance sheet is purely money's coming into my business. Yeah. So the profit and loss is the net of the sales and the costs. And that's how much I've made in the month. This is money I've made in the past. And the rest of it is money that I've borrowed from somebody. So it comes into the business and then it goes out of the business. Okay, and that's all a balance sheet is. It's just a statement of account of where's my money. Because I don't have it on me. It's not in my pocket. Okay, so we've got to look at this, because if my profit and loss account is showing one set of figures, what can happen is, you know, I could have a very high stock figure. I could have loads of debtors that have not paid yet, which potentially may never pay. They may become a bad debt and could affect my profit and loss. I could have loads of fixed assets that are not fixed assets. They should have gone to jobs, and I should have charged them out. Okay, so we've always got to do a balance sheet as well as a profit and loss account, and make sure, number one, make sure this figure here, this profit, yeah, agrees to the profit of the profit and loss statement. So if we go back to here, okay, so this figure here, or this figure here, yeah, should equal this figure here. Okay, so that's always our first check. So the profit on the profit and loss account agreed to the profit on the balance sheet. And if it doesn't, then there's something wrong. There's something misaccounted for in my accounts. Okay, so those really are our two main statements. Now, our profit and loss, money comes in, goes out, trading activity of the business, balance sheet, snapshot, where is it? Where's my money gone? And it's nothing more complicated than that. Okay, so every debit is where's my money gone. Every credit is where's my money come from. And if you think about the profit and loss account, the same thing is true. Yeah, income is a credit. Where's my money come from? Sales. Expenses, overheads are debits. Where's my money gone? Costs of my business. So any questions around the balance sheet? Has anybody ever looked at a balance sheet and ever wondered what this is, or any terminologies on balance sheets? No? Excellent. I'll take that you've all seen them, or you may not have seen them yet, and you're now looking forward to seeing a balance sheet. So once we've got our profit and loss balance sheets coming out of our account systems, again, most of us are using electronics, so things like Xero, QuickBooks, Sage. These systems will just produce these at the touch of a button. Okay, so at least once a month you should be pulling these off, looking at them, making sure they are there. Then once we've got that and we're in the habit of doing that, now we can start to do our projections. Now we want to start doing our budgets, which are our projections of what we think they're going to be going into the future. So an annual budget is a pragmatic view of what the business can do. It's a scenario analysis. Well, what if I did this? What if I doubled my sales next year? What if I tripled my sales next year? What if my sales were half of what they are this year? Okay, we're trying to, there is a bit of crystal ball gazing here, but it's just a way for us to go through a process to say, what if I did this? What if that happened? But eventually, what we've got to do is they're just a measuring stick. So we put a stick in the ground that says, right, I think I'm going to do that, and I'm going to judge myself against it. So if I was running a marathon, I do all my training, and then I would set myself a goal. I think I could run a marathon in 4.5 hours. Okay, and that's my stick in the ground, 4.5 hours, and then I'd run the marathon and I'd see whether I'd beaten. Now, for some, it will be a personal best. Well, I ran a marathon in 4.5 hours 2 years ago. I think I can beat that. That's fine. Okay, if your personal best is going to be your budget, that's great. But for business, because we should always be moving forwards and growing, I would always say, our budgets really should be based on what the market potential is, rather than just what we did last year. So taking last year and adding 5%, 10%, to me, that's just lazy budgeting. We should look at it and say, well, look, what could we do? If we knew we couldn't fail, what goal would we actually aim for? So Sabrina and Josh, for you guys, with that meeting with Primrose yesterday, that's now giving you the confidence for next year's budget to be twice what we did this year. Yeah. Because your customers said, I'll double your orders if you can supply it. So great. So it's not last year plus 10%. We now know our biggest customer wants twice the amount of volume. Fantastic. Great. Now we're going to set what we call a big, hairy, audacious goal that we can actually aim for. And if we want to get funding for anything, we have to have a budget. Because anybody lending you money, is going to look at last year and the previous years, but it's also going to want that confidence that you're trying to predict what you're actually going to do, that you've thought it through, you've gone through the process, and you're looking at this and saying, yes, we can actually achieve that. Okay, so if you want to borrow money, then you have to have it. And the key thing for me, it sets your reticular activating system, your RAS, okay, that little part of your brain that looks out for opportunities to actually achieve it. And that's why I'd always say, don't set a realistic budget, have a realistic budget, but set a target, set something that stretches you. Because by stretching you will actually push your reticular activating system to find ways to actually achieve it. So in my old days, we used to have 3 budgets. Okay, we'd have a budget for the bank, which was always pessimistic, because you never go to a bank and show them too much optimism. Okay, we'd have a budget for ourselves, and we'd have a budget for the team. The team budget was always 10 to 20% more than our own budget, because we always wanted to push them up here, but we wanted to know actually the chance of actually achieving that is going to be pretty slim. But if I set it here, we're more likely to hit here. If I set a budget here, we're going to be here. Okay, so we had an optimistic one, a pessimistic one, and a realistic one. So we had our 3 budgets. Okay, again, scenario analysis. What if we did achieve this? What if it all went wrong? What if it was somewhere between the 2? Okay, so, but ultimately you want to have one and then commit to it, then stick with it. Because it doesn't matter what it is, it's just a stick in the ground that we're going to monitor how we're doing towards it. So the next level then is to understand our break even. So we've done our budget, we've got our profit and loss account, we must understand our break even. So our break even is at what point do we actually maintain or meet all of our costs. So if this is our fixed cost level, 500,000 a year, so this is rent, rates, light and heat, establishment costs, administration costs, all the costs that whether I sold 1 unit or sold 1,000 units wouldn't make any difference on those costs. The cost of actually having a business in existence. So I've got to understand what my fixed cost line is, you know, what level that is. Then I've got my variable costs. So these costs now go up with my sales. So, you know, as my sales goes up, we see here, as my revenue goes up, my costs go up. So this line here, this ratio is the same, okay? And at this point here is where my variable cost plus my fixed cost agree to my sales. So this is what we call the break even. So up here, we make profit. Down here, we make a loss. And we know here that on this case, it's 15 units I need to produce in order to break even. So that becomes our first key performance indicator. How many units do I need to produce in order to start making profit? I know if I'm making 16 units, I make a profit. If I'm making 14 units, I make a loss. So every business needs to understand what its break even is, because that should be our number one goal. That's where we should start from. Okay, and so that's our loss, that's our profit. So by doing that, so here if we've got our fixed costs and our variable costs, we've got to understand what goes into each one. Okay, so our fixed costs are expenses that we pay whether or not you've got any sales. Okay, and variable costs are expenses that only incur when we actually make a sale. So for A Roberts guys, you know, plant costs are variable because you only incur plant costs if you actually sell it. Yeah, whereas your rent is payable whether you sell one item or 1,000 items.
Yeah.
Okay. Now there will always be sort of costings that are what we call semi-variable. So labour, yeah, can be fixed and it can be variable because, you know, I've got to employ somebody, yeah, and whether I sell 1 unit or 1,000 units, I've still got to employ that person. But there's an element that the more I sell, the more people I need. So we generally split direct labour as some of it as variable costs, direct, and some of it is overhead. How you split it is really down to you. It doesn't really matter as long as you're consistent. As long as you build that into your pricing models and you're consistent, you consistently apply it. Don't have it including direct costs 1 week and then including overheads the next week. Just be consistent, make a call on it. Okay, so we've got our fixed costs and our variable costs. So if we want to calculate our break even, it's a relatively simple calculation. So it equates to the overhead, yeah, so our fixed cost divided by our gross margin, our gross profit percentage. Okay, so if I've got an overhead of 500,000, okay, and I've got a 20% BP, gross profit, gross margin, yeah, then my break-even sales figure is going to be 2.5 million. Yeah, 500,000 divided by 20%. Okay, so I'll do it. I can do it the other way. If I do 2.5 million at 20%, that's 500,000. Yeah, and my overhead is 500,000. Yeah, therefore I make nothing. So you should always be able to work break even backwards. Yeah, from this ratio here for overhead divided by gross profit percentage. Yeah, and then you take sales. Yeah, at gross profit minus overhead equals 0. Okay, so we should be able to calculate that in a volume base, how many units, or a turnover base, how much sales we need to do. And ultimately, if you broke that down, you could come up with what your break even is per day. So per day, we have to generate X number of boxes per day in order to make our sale. We've got to charge out X number of hours. Yeah, we've got to do X number of units per day. Then every day, you know that if you get more than that, you're winning the game. Okay, because we can't wait till a whole year goes past before we know whether we've won or lost the game. Okay, we've got to look at it on a very regular basis. So those really are our financials. So as a finance director, so when you wear your finance director's hat, those I would say are your fundamentals. Okay, make sure your bank reconciliation reconciles. Make sure you've got a cash flow forecast. Make sure you've got profit and loss, a balance sheet. That you're looking at your cash flow strategies, collecting money, making sure it's not tied up. Yeah. Make sure you understand your break-even point, and make sure that you've got a budget in place that we're actually monitoring our activity to. If you do that as a finance director, you're not going to go far wrong. Okay, those are the basics. So if you are the finance director, if that's one of your roles, you've got to find time each week, each month to actually put that hat on and go through that process. Yeah, if you've got somebody doing it, you've got to keep them accountable and make sure they're doing it. If it's outsourced, doesn't matter, you still got to make sure they're doing it. Okay, because the ultimate responsibility is going to be down to, you know, the MD and the shareholder to make sure this stuff is done. So that's the finance. So I've spent quite a bit of time on it because that was the one that most people sort of struggle with understanding it. And it's simple. It's not always easy, but it's very simple. That's just really the essence of it. So when an accountant provides you that information, that's all they're providing you, just in a multiple in many page format. Okay, because there's more detail behind it. But in essence, it's just those two things. So if we move into sales and marketing, okay, so now we're going to put our sales and marketing director's hat on. So Phil, if you're still with us, I'm not sure if you are, you're still on the screen, but so sales and marketing is now thinking, right, we're now here to drive sales. Okay, that's what sales and marketing director is. Marketing is about lead generation, sales is about conversion. So we're now splitting those two down. And if you come back to the Action Coach 5 ways, you know, we're looking here, this is our sales. So we've got new business, marketing, sales, and then we've got account management, repeat business, of making sure our clients stay with us, yeah, and buy more from us. So in a way, yeah, even as sales and marketing director is actually wearing 4 hats. I'm wearing my marketing hat, my sales hat, and my customer service hat. Okay, so we've got to make sure that we're actually looking at this and actually having KPIs around each of those. So where's my lead generation KPIs? Where's my conversion KPIs? Where's my repeat business KPIs? Where's my average transaction KPIs? Okay, and I deal with more of those in the sales and marketing workshops. So I'll go into more detail of how we create those. But they should have, so as the managing director of my business, I want a meeting with my marketing manager and my sales director, you know, on a regular basis to review those 5 ways numbers. Where's your 5 ways numbers? Where's my return on my investment in my marketing and my sales? Okay, so it's going to be around there. Any questions on sales and marketing KPIs? Who's sort of driving that at the moment? Anybody? I know Ranjit's working on a few. What about Fatima? You there, Fatima?
I'm here.
Yep. Are you working on sales and marketing KPIs at the moment?
So I'm assisting, I think you met my colleague last week, but I'm assisting him with sort of marketing strategies to be able to, well, just, you know, get more people looking at what we're doing.
Yeah.
As part of a healthcare provider.
Yeah.
So I'm working. Yeah.
So if
so
you're
I'm
marketing, your ultimate KPI is the number of leads you generate.
Exactly.
Yeah, but then I'd want to know, right, I've got probably 5 or 6 strategies that are driving my leads. So how many leads do I get from my website? How many leads do I get from pay-per-click? How many leads do I get from my emails? How many leads do I get from Facebook? How many leads do I get from newspapers?
Yeah, and
So
that's
just
exactly
like we did with the account, you're breaking these down into more detail and then reporting on those. But the ultimate goal is you've got to drive more leads. And if you're doing that, great. If you're not doing that, I want to see a strategy around what are you doing to actually get better results.
Yeah, that's exactly what we're trying to work on at the moment. Yeah.
Right. Cool. Good. Okay. So that's really sales and marketing is just knowing your 5 ways numbers and recording on those. Then we move into operations. So now we're putting our operations director's hat on. Okay. And we're starting to look at this and say, right, operationally, there's 3 key things that we're looking at here is, can I deliver on time, on budget, and on specification? So what the salespeople have promised, can I deliver on that? So we've got to have KPIs that say how many products, services do we actually hit the time frame which we said we were going to do it? How many of those did we actually achieve that within the costings that were built into the sales? And were there any quality issues? Okay, so we start looking at these things really down into, again, we're starting to break this down now into far more detail. So, and always think about what your limited resource is. Okay, because every business has a limited resource. So if I employed 100 people that work 40 hours a week, what's my limited resource?
400 hours?
400 hours. Or 4,000 hours, isn't it? 100 people, 40 hours.
Oh, yes, sorry.
So my limited resource is I don't have more than 4,000 hours. So one of my rates must be production per hour. Because I know once I've got to 4,000 hours, I can't produce any more. So what capacity am I running at? So always think within this, what is my limited resource? Every company has it. It might be space. It might be hours. It might be the products that I can actually produce. It might be purchases. Okay. Every business has a limiting resource. So know what it is and then come up with my rate per that limited resource is this. Because that will be one of your key performance indicators. Okay. So you're looking for, rates around or, performance around these key things, time, costings and specification. So a good one on this one is going to be around wastage. So what am I wasting? Am I wasting hours? Wasting limited resource, wasting product, wasting time. So where's my waste? Because I can limit waste. So the Japanese have a word for waste called muda. Okay, so the whole of lean, if you've heard the concept of lean manufacturing, is to drive waste out of an operation. Because waste is just waste, it's just costing you money. Okay, all the ISO regulations are really to make sure we achieve these 3 things: on time, on spec, on budget. Now, for service providers like Platinum, you guys, where you're dealing with a care home, this one's a little bit more difficult because, how do you set a budget for caring for elderly people? Yeah. Okay, so, but you've got to go back to what the core is, what you're trying to do, how do you drive profit, and you might sort of say, well, your on spec is the number of hours we spend with each individual patient. Mm-hmm. With each of our clients. It might be the number of activities we do. It might be, I know one of the key things for you is the Ofsted.
Yeah. It's CQC.
CQC reports.
Yeah.
You want to get all your sites to outstanding.
Mm-hmm.
So if you speak to CQC, they will give you the entire spec of what creates outstanding.
Yeah.
And those become your key performance indicators.
Yeah.
Okay, but there's no point in being outstanding, and losing £1 million. Because you might have every site outstanding, but none of them are profitable, and you're out of business within 12 months.
Yeah.
So you've got to look at it into that detail. Is what is the game we're playing? How do we play the game? How do we play it better? What are our resources that we're trying to manage here, and what does success look like? Then you start boiling that down. Then you can put key performance indicators to. And what you're looking for though is this concept of marginal gains. How can I just improve each little area by 1%, 10%, 5%? Okay, not one thing by 20%. You'll never achieve one thing by 20%. It's lots of little things. Improve this, measure that, improve. Once it's measured, once it's improved, move on to something else. Don't think that a KPI is a KPI for life. Okay, it's a key performance indicator. What is key that period? Might change next period. Okay, I might move on to another. I'll have something that warns me if it goes out of kilter, but I'm moving on to the next area, the next area, the next area. If you think about high performance sport, is they never stop. Formula One, they never stop trying to find that extra second. Where am I going to find that second? Where is it? Where is it? Where is it? Where? And it's that pursuit of excellence that keeps them at the top of their game. As soon as you go, yeah, we're perfect, everything's done. If you're going for outstanding, as soon as you achieve outstanding, you've got to set the next levels. Right, we're going to go for super outstanding. Because that pursuit of excellence is where the real benefits come from this. Okay, you've got to keep driving, looking forwards. So that really, when you look at that concept of operations, you really are looking at this. Imagine your business is a bicycle, and you wanted to get an extra, 2 miles an hour out of your bicycle. What would you do? I'd pull my bicycle apart and I would check everything and see how everything can be improved by 5%, 10%. And then I'd put it back together again and see if I get better performance. If I do, fantastic, great. What would I do then? I'd pull it apart again and try and get another 5% out of it. Then I'd put it back together again. I've got it, great. Oh no, I've gone backwards. Right, now I need to put it apart again and do it again. This is why we say that business is an infinite game. It never ends. Okay, it's always ongoing. There's always places to improve, to move forwards, because the world around you is changing as well. Technology is changing. Okay, so just we think we've got it perfect. Yeah, it's not perfect anymore because something else has come along. So, financials, profit loss, balance sheet, cash flow, break evens. Sales and marketing, 5 ways: lead generation, number of transactions, average transaction value, repeat business. Operationally, on time, on budget, on spec. Whatever your version of that is, that's what we've got to find out. Break it down, marginal gains, improve, put it back together again. The final one is HR. Okay, and this is where a lot of people get stuck with HR. I don't think they treat HR strategically. It's just a tick box exercise to make sure everybody is, compliant. Yeah, but HR is far more than compliance. HR is strategic. Your number one asset in your business is your people. Okay, therefore you should put as much effort into your people as you do in your sales and marketing, into your finance, into your operations. Okay, your people are critical. And the measurements from that, though, it's always more difficult with people because sales, lead generation, it's all numbers driven. It's nice and easy to find a number that we can work on. When we're dealing with people, there are no numbers. So we have to create those numbers. We have to create the measurement system in which we're going to measure. So if you think about, and I always think, if you think negatively in this, where could it go wrong? Yeah, where would be, yeah, if I was going to go bust next year because of my people, what would be the 10 things that could go wrong, you know, that my people could get wrong? Okay, so they could be sick, they could all go off on sick leave, they could be absent, they could be miserable. Okay, so these can then be the areas in which we can now measure. So let's measure the sick leave, the absenteeism, because these are generally early warning systems of something inherently more of a problem. Because often when we run our businesses or we're managing teams, we're too busy doing the stuff that we're doing always to see what's actually going on with our team. So if we can have these early warning signs, you know, if sick rate starts to go up, absenteeism starts to go up, then we generally feel there's a bit of, you know, bad feeling going on in the organisation. Happiness, you know, how do we measure happiness? Well, it's a difficult one. You know, where you can start is, you know, record every day when you walk into the office, how happy does it feel? You know, it's subjective, but yeah, if you've got your criteria, you can always come up with a metric. Yeah, or you can survey the team. You know, send a survey out, happiness survey. Right, 5 questions. Answer these questions. We'll do that once a month, once a quarter, and we'll monitor it. You know, if we start to see the numbers drop, then we can look to do something, or we can be doing something anyway and see if we can increase the numbers. I said we should always be looking to improve, but somebody needs to own these. Engagement, you know, how engaged are they? Again, we've got engagement tests we can do. Personal growth, yeah, are our team on a whole actually growing? Are they improving? Is their skill set? So how many qualifications, you know, how many qualified people have we got? How many people are going through their NVQs? So in a nursery I coached many years ago, we put this metric in. So what percentage of our team, you know, were on a course? And that metric had to be over 80%. Okay, and of those people, how many of those people were achieving distinctions? How many people were achieving, you know, high-level grades? Because we're a high-performance team, therefore we wanted high-performance people. Okay, so this is what I love about business, because it's very difficult to me to say, right, this is the set of metrics you use, go and use it, because every business is different. Every business will come up with a unique set of indicators, because what you're focused on will be your indicators. Next month, they might be completely different. The month after that, they might be completely different. Okay, so you've got to take ownership and say, right, this quarter, this month, this year, these are my indicators. This is what I'm going to measure to get that improvement through my people, my processes, my operations, my sales, my finance. And ultimately, yeah, we want to look and say, right, who owns what numbers? You know, the shareholders, you know, an MD, they own the profit and value. So as an MD, on a monthly basis, you should put your MD hat on and go, right, where is the profit in my business? Where's the value in my business? Has it improved since the last time I looked at this? If it hasn't improved, ask the question, why has it not improved? What am I going to do about it? Marketing, yeah, leads, sales, conversion. These two guys together are responsible for the sales figure, the headline turnover. Now, this is sort of an interesting one, because you get these two people here, yeah. If sales are down, so imagine you're the managing director, okay, and you're meeting with your marketing and sales directors, okay. If sales are down, who's the marketing director going to blame?
The sales director.
The sales director, yeah. And who's the sales director going to blame?
The marketing director.
The marketing director. No, you haven't given me enough leads. I've given you loads of leads, you haven't converted them. So there will always be tension between these two. Okay, and the managing director's role is to manage those that tension through the numbers. I don't care how you feel. Show me the numbers. How many leads did you generate? What's your conversion rate? Takes the emotion out of this. We said that right at the start. Our beliefs, if numbers become emotional, then we're looking at them wrong. They should make us motivated to do something about it, but we shouldn't be sitting there going, oh, pity me. We should just be looking and say, right, we did that number of leads. Okay, great. How are you going to make it better? And then operations, direct costs. Okay, operations drives direct costs. Then between these three, they now look after gross profit. So if gross profit's down, the MD holds these three accountable. Who does operations blame for gross profit being down? Josh? Have to push the space bar.
Who do operations blame?
So MD's holding these three people. Operation, gross profit's down. Who does operations blame?
Sales.
Sales and marketing. Yeah. Who does sales and marketing blame? Operations. See, these two were fighting amongst themselves. Now they're ganging up on operations.
Yeah.
Okay, so there's a tension now between these two, which the managing director has to maintain. Okay, now I add in the finance director, who looks after the overheads and balance sheet, and ultimately between these four now are responsible for net profit. So if net profit's down, who does the finance director blame?
All the others.
All the others. Who do they blame? The finance director. So you can see, if we don't manage this as the MD, or if we are all of these people, if we're not having this conversation in our own head, then that blame, excuses, or just denial, we'll ignore it because I don't understand it, means the company just never moves forward. We need some tension. It's like I call it, it's a tightrope effect. Okay, so if I've got a tightrope between two poles, if it's too tight, so if this tension is too tight, what happens to that tightrope?
It's too tight.
If a tightrope is too tight, what happens to it?
Breaks.
So if I have too much tension here, it's going to snap, and one of these, if not more than one, will leave.
Yeah.
If that tension is too loose, so I've got the tightrope and it's too loose, no one can walk across it, so everybody underperforms.
Yeah.
Because there's no accountability across the line, because no one's focused on the number one goal of driving the business, which is make some bloody profit.
Yeah.
Okay, so the MD's role is to ensure that tension is just about right, and it's never perfect. It's always too tight. It's always too loose. So we're constantly tweaking it. If it's too loose, we tighten it up, put more pressure on. If it's too pressured, we take some pressure off, give some support.
Yeah.
That to me is the number one goal of an MD, is get the best out of that team that's around them. And obviously, we put the HR on there, which is the people and happiness. Because that, we could be doing this, driving net profit, everyone working really hard, and we've just annoyed everybody in the organisation, and our whole team just leave. Okay, and that gives us the longevity of the business. So the business then will survive because it's got happy people, making profit, and then the whole thing continues ad infinitum and continues to grow and move forwards. So one of the key things for this is, when you drive a car, you have your key performance indicators, your revs, your speed. Do you need to know how the engine works? Okay. To drive a car, you don't need to know how the engine works in order to measure the KPIs. As long as you know what the KPIs are, and you then know what questions to ask and what to do about it. So it doesn't matter, you know, when people get hung up on, so I don't care what KPIs you measure, just measure something and improve it. Okay, and then measure something else and improve that, and measure something else and improve that. Start somewhere. If you've got nothing, start somewhere, measure it, improve it, and that will lead to the next thing, to the next thing, to the next thing. Okay, but if you're running a business without measuring, you cannot improve, and if you're not improving, you're not growing. You're not going to move forwards. Okay, and the more people in the organisation that are measuring, the more people that are monitoring, the more people who are actually taking ownership and doing something with it, the quicker and easier that business will move forward. If it's only you as the owner or the senior manager and no one else is measuring, then it ain't going to work. Okay, it's going to be a long, hard struggle. And I think I've done this analogy with some of you before, but I call it the 10-pin bowling analogy. Okay, so you're playing a game of 10-pin bowling. You know, your employees are bowling the balls. You've got the skittles down here, and you're basically holding. You know, so if this was a pin, you're holding a blanket up in front, and they're bowling balls to the pins, and you're not telling them what they're getting. They're going to be bored within 5 minutes. Yeah, you could tell them, right, you've got 1 down, you've got 2 down, you've got 3 down. Well, that's hard. You've then got to manage them, and you've got to do hard work. The best way is take the sheet out of the way, show them what the game is. Right, you've got to get more skittles down. They'll learn to play the game. And as long as that game ultimately relates back to this and this, okay, so you can track it back. If I do this, ultimately this is going to drive profit. Then we're all moving towards the ultimate game of the business, which is to make profit. If we're not doing that, we're not moving forwards. So, any questions around KPIs?
No.
Anna, anything from you?
No. Can you hear me?
Yep.
I don't think so. I think we're changing. We're making so many changes. We've started to measure things, but so it's become a bit confusing. Too many measurements and not enough results, if you like. So we're sort of going to go back to basics, I think.
Go back to, if you've got too many, then go back to the ultimate essence of the game, which is sales and profit.
Yeah.
We'll start there.
Yeah.
Okay, and then find something that drives one of those. You know, what drives one of those 2 measures. You know, sales is going to be leads and conversion rate. Yeah, profit will be on time, on budget.
Yeah.
So just start with that, and then build on it. If you measure everything, you know, certainly if you're measuring something, measure something that changes.
I didn't say they were accurate measurements either. It's a little bit sporadic, so it's just a time waster. It's a waste of time because there's no target, if you like.
Unless it's, and sometimes you will measure stuff that you measure it and it actually doesn't help you.
Yeah.
You know, the number doesn't change that often, or you know, you do this and it doesn't affect it, then forget it and find something else. Yeah, again, go back to the cycling analogy. You know, they had an issue. They were trying to get more speed out, so they put Vaseline on the spokes of the wheels, and they thought that was going to help. And then they measured it, and they realised it had no influence whatsoever on the speed, so they just stopped it. You've got to be prepared to fail. As soon as you start measuring, you've got to be prepared to fail.
I suppose it's a bit of trial and error.
It's 100%.
Yeah.
Yeah, 100%. It's try this. Yeah, great. No, move on. That's why I say failure is not a failure. It's not a negative. Failure is just a learning that, right, that's not the way we measure this.
Yeah.
Or that's not the way we improve this. So let's find something else that we can measure that will lead us to improve it.
Thank you.
Okay.
Yeah.
So home fund. The the first thing that you must all have in my book is, I'm assuming that you're all doing profit losses and balance sheets, or you've got an account system you can produce that. So that's taken for read. Get your reports out, but do your business budget. Forecast forwards for the next 12 months. If you're halfway through the year, take 6 months actual and then forecast for the balance of the 6 months. Okay. If you're an employee, if you're working for somebody else, then get them to show you what the forecast is, because you've got to know what game you're playing. What are we aiming for? What does success look like at the end of this period? If you don't know what that is, then you can't play this game. Okay, and be prepared to challenge it. Be prepared to ask, why is it that? What's that? Why couldn't it be twice? Why couldn't it be 20% bigger? Because that's what drives the thought process to actually come up with bigger and better numbers. Identify your limiting beliefs. So really, do take that time out. Write down, all of those negative thoughts you have about money. Okay, and then assess each one and say, right, do I need to change that belief for me to move forward? Okay, now beliefs aren't going to change overnight, guys. It's not. I'm not thinking you'll just write it down suddenly you'll change it. But the first step in change is awareness. Be aware that you have that negative belief around it. If you want then some ideas, some books to read to help you with that, let me know. There's some really good authors out there that have written about this. And then the final one is set a KPI dashboard. As Anna said, pick 1 or 2 areas, start measuring those, work on ways to improve it, then add. So treat it like spinning plates. Go get one plate up and running, spinning, then start another one, then go back to that one, check it, go back, set another one. If that one's not working, ditch it, start another one. Okay, don't try and do 100 KPIs in one go, because you just won't get the measurement of them properly or be able to do anything with it. So. Good. And finally, take action. Do something with this knowledge. Okay, it's all very well, getting that overview, but unless you actually put it into practice, nothing changes. Okay, so really think about what you're going to do to move it forwards. So I'm just going to quickly finish up with top learning and one thing you're going to do as a result of today. So as you're first on my screen, Sabrina.
Oh, no. Well, okay, the most important thing is to actually to do something, to get some KPIs into action. I mean, there's one overall picture for us is that we have to be able to produce more in less time and with fewer people. In other words, more efficiently and smarter. So, yeah, I've got to think about, and with Josh, what's the best thing to start measuring?
Yeah, pick just first thing, pick an area. Sales, marketing, operations, finance, or people. Pick one area and then pick a KPI around that area. So, cool, good. Josh?
Well, KPI that I use anyway was, we've got one that we brought in a couple of months ago, which is number of boxes per hour. So using that and measuring, carrying on getting more data and seeing how we can improve it.
Yeah.
It's fun. There's certainly, and there's more ones. So the ones with operational is like the number of potting we do. That'll be one more to bring in. Because at the minute I don't measure it. I haven't got a clue if they have a good day potting or a bad day potting.
Yeah.
For plants, for example.
And that's a really good, that's a good question to ask. How do I know if today's been a good day? If I can't measure it, then measure it. How do I know if today's been a good day?
Yeah, and we didn't know. We didn't at the beginning of the COVID-19. We didn't know.
Yeah.
If we had a good day or a bad day, really.
Yeah.
But now we do. We do anyway.
And it's never a bad day. It's just not such a good day. It's a day that we can get better tomorrow. So cool. Ranjit, what's what's your top learning, and what are you going to do to change?
Yeah, I need to get back on measuring KPIs. I kind of stopped for a period of time just whilst work built up and started to employ staff. So ideally, if it's possible, could you send me over the Excel sheet for the leads times conversions times, etc., etc., and I can then begin to probably monitor that on a weekly basis. So I have some idea of some key KPIs, like the average spend, the average revenue per project, etc. But I need to look at it more holistically.
Cool. Okay. Can you just email me, Lance?
Yeah, sure.
I won't
What's the sheet
remember
again?
tomorrow. So
What's the sheet called, Kevin? You have it on your desk out the front.
The 5 ways KPI
5 ways.
sheet.
Yeah.
Okay. I'll ping that over to you. Cool. Anna?
Ours, as always, is real-time figures, which is so important.
Yeah.
Which there has been time to work on that, so that's improved. But with Matt and I looking at streamlining our services and looking in more detail rather than having. Excuse me, my daughter just interrupted you. Could you go away, please? Sorry about that. Looking at the scanning is really what's picked up since COVID. So that's going to be our main focus going forward in the next month, and we'll see where we go from there. We're just trying to take it one product at a time. Yeah.
Just think about what's the most important area for me this quarter, because we should be doing that with our 90-day plans anyway.
Yeah.
And then have measurements around that for this quarter.
It's pretty obvious looking at the figures where what's the best position is, and the inquiries that have come in since COVID directly go with what our thinking was, which is good, I guess. Yep. So it gives us a course of action. And looking at our A, B, C, D customers, like we talked about.
Yeah. And don't forget, what we want to avoid is, measuring stuff and putting effort into measurement that we're not going to take action on.
Yeah.
Because at this stage you're wasting time. Measure things that you go, right, I'm measuring that because I want to make change. I want to improve it. That needs to be that driver.
Yeah.
Okay.
Thank
you.
Fatima.
Hi, sorry, this is Yasmin. Fatima just had to leave, but I've taken over. Hi, sorry. We do use KPIs, and I think we use KPIs more as a comparison across the homes in the group. So, like you were talking about the small changes, where you can make small changes, we look at how we might be able to speak to new suppliers and maybe bring costs down by having preferred suppliers and better ways of fixing pricing so that we can make savings in those kind of things. I think because we're a service industry, like, people are really important, so the labor cost to a certain degree is fixed for us. But I think the changes that additional costs like PPE and things like that, we need to kind of like incorporate into those KPIs to see what difference it's made. For us, I think for me, it's always about looking at the bottom line. Sorry, I know it's like, might not be the right terminology, but it's good because of your explanations, I've been able to understand slightly more about those detailed profit and loss figures and looking into those a little bit more and have more understanding in that. Yeah.
And I think you've got to look at what your profit drivers are. So what drives profit in your business?
Yeah. Well, I think for us, because it's people, we need staff. So we do have to invest in our staff. So we have to make sure that we give them training, that they gain qualifications, that they're able to do their jobs well, that we're able to retain them because we invest in them. So obviously you want to keep them, that there is promotion, you know, that we give them ownership so that they feel valued. So in my role as operations, that HR part comes into it a lot as well.
Yeah, there's going to be a big overlap with HR KPIs for you.
Yeah,
you know,
but thank you.
But I think, you know, looking at where your profit comes from will be around, you know, obviously because your limited resource is actually your care homes. So how many spaces have you got? So, you know, a classic KPI from that would be occupancy. So what percentage occupancy are we? But the other thing that I think is really good as you do grow and you have different departments, or as you know, Yasmin's got you know, different sites, is bring some competition in between those sites. You know, as human beings, we love a bit of competition. You know, again, be careful of that tension. That don't make sure it's not negative. That it's I've got to win, you lose. You know, because the ultimate game is making profit, but a little bit of friendly rivalry and competition is really can stimulate ideas.
Okay.
And you could learn from each other, and you know, and everyone improves. If you think, yeah, F1 does that really well. You know, they're all competing, but they do work together. You know, they do learn from each other.
Yeah, I think what we try and promote with the managers is that they share good practices. So if something's working in their home, and maybe if somebody else is not doing it yet, then they share it and see if it works for them. And
test the measure. You know, try one KPI out in one site, another KPI at another site, see which ones make, and then you can say, right, well, let's adopt the best ones.
Yeah.
Right. So to really think, you know, the ultimate game is for the whole company to make profit. But within that, we're playing games within games within games within games within games. And as long as everyone's engaged in a game and they know what the scoring system is and what success looks like, then they'll play it really well. So.
Yeah, I think what we've learned just now is that maybe we don't have a mission statement for everybody to actually work from.
Mm.
So that's what we're trying to develop now, and that's where Fatima has come in, and trying to develop something that everybody plays by, you know, the vision. Yeah. One vision.
Great. I mean, a good book to read on that is Good to Great by Jim Collins. And the other book to read, if you're interested in this stuff, is The Great Game of Business by Jack Stack. That's all about gamification of the business, you know, the infinite game, playing games within games. If you play a game, you have to score it. So. Good. Right. Well, we've run over a little bit with that finished, so I will say thank you very much for attending. I'm sorry my audience here didn't turn up, so but hey-ho, that's the way it goes. So I will be recording this, so if you do want to come back and pick up anything, then please do watch the recording. Otherwise, yeah, if you do want me to send you anything from what we've covered here, just ping an email with what it is. I'll happily send that over to you. So otherwise, have a great evening, and we shall see you soon. So,
thank you, Kevin.
Okay, everybody.
Thank you very much, Kevin.
Ta-da.
Bye.
Bye.